Testing, testing. All right, guys. Sorry, a little bit of a late start here. I had some technical difficulties. Morning. Let's get this show on the road. My head's not in the right spot. I was being a tech support guy today, trying to tech support my own equipment, trying to get it up and running. I had a little bit of problem with the modem, but I think we got her all worked out, figured out, ready to go, ready to rock and roll. All right. My name is Lan Turner. I am the former instructor of the Chicago Mercantile Exchange and Chicago Board of Trade. And I am a current instructor at Utah Tech University. And this is our lab. And I had a class on Wednesday night where we talked a lot about different crazy things in the stock market. And we haven't been doing a whole lot of stock market stuff because I'm so enthralled with day trading. Yesterday, we kind of got sidetracked and sidetracked, that's for sure. And we went crazy yesterday. And I know I'm supposed to be doing more on stocks because it's our stocks class, but I kind of got derailed on that too because I had my son come, and he is a financial analyst, and so I had him coming as a guest speaker. And so I didn't get to do the stuff I wanted to do for the class, which is okay. I mean, the stuff he did in class was fantastic. That's why I say we had a fantastic class, because we kind of went in a little bit different direction, which was a lot of fun. I really enjoyed it. And I wanted to go over and I wanted to do a little bit of that today. So we're going to do a little bit of the follow up on Ben's class on some of the things he talked about. And we'll do that a little bit in just a few minutes. I wanted to kind of play. Bitcoin was in the news big yesterday, so there's a lot of Bitcoin news going on, and we can trade Bitcoin here in the futures market. And so I wanted to highlight that a little bit and just kind of bring that back up. I know most of you guys know that you can trade Bitcoin over here. So I thought it'd be fun to just look at those charts and look at them a little bit. We'll go back over and look at the this is the Bitcoin charts. And so this up here in the upper right-hand corner is the range bar 6 Bitcoin. Up in the left-hand corner is the 2-minute. Down in the bottom left-hand corner, that's the 15-minute. And in the bottom right-hand corner, that's a 5-minute Bitcoin chart. And you can see it's in the news big, and that's probably why it ran so hard this morning. So I had a big burst this morning. If you come and look at the daily chart, and I know many of you might not be into Bitcoin, and that's fine. I've got a little bit of Bitcoin. I don't have a whole lot, but I do have a little bit of Bitcoin. And they just came out with an ETF and created an ETF for Bitcoin. And Ben in class the other night, and kind of the reason I wanted to bring this up and talk about Bitcoin a little bit was because in class, he talked about how ETFs are created, all right, and how they are a closed system. And so it was kind of, I mean, I kind of understood all this stuff, right? You have to understand the differences between Ben's formal education and my formal education. I've been formally educated at the Board of Trade. I was there for 10 years. And so that's where I learned how to trade. And so my specialty is technical analysis, right? Ben has been formally trained in fundamental analysis. So as a father-son duo, we kind of fit really well together because he does the fundamental side and I do the technical side. And when we meld those two together, you have a 1, 2, 3 knockout punch, as we like to say, right? You do the fundamentals and the technicals. You need to have both. I've always said you need to have the fundamental nature of the market so that you can have the technical side. So you got to have the fundamentals that tell you what to trade, and then you have to have the technicals to know when to trade. And there's a big difference between the fundamentals and the technicals. Fundamentals don't tell you when to trade. They don't tell you when to trade. They just tell you what to trade. The technicals tell you when to trade what you've learned to trade. All right. So if you know what to trade, now the technical side, you have to learn when to trade it. And that's what the technical side is. So I'm a technical analyst. I specialize in technical analysis. I teach technical analysis. Ben, he teaches fundamental analysis. He's an expert in fundamental analysis. So he does fundamentals. Of course, Ben's very smart. I mean, who's not proud of their son, right? But he's very smart, and so he does technical analysis as well. So he's very well-rounded in that regard. But he was telling us how ETFs are created, and the reason I wanted to bring up Bitcoin is because they just made a new ETF in the Bitcoin world, right? They just turned Bitcoin into an ETF. And so there is an ETF symbol, and we'll go look at that here in just a minute because I've got it on the stock side. But the way an ETF is created is they have to buy or they have to own all the stuff that's in the ETF before they can create the ETF. What? Yes. They have to actually own all the stuff, whether it's a stock, a bond, a note, anything, cryptocurrency, anything that they create an ETF, they have to have it, they have to own it first. So they have to have all this buying where they buy up all this stuff. So in this case, they created a Bitcoin ETF. So they bought up the ETF, all the Bitcoin, and then they put it into the ETF, and now they have the ETF. So now once they have the ETF, they can offer it to the market to trade. And so you can trade it back and forth, but you're not actually trading the actual stuff they bought. They have it and locked it up in the ETF. And then you trade the shares of that ETF. It's kind of like the company. We were talking about it in class the other night, and it's kind of like a synthetic company. An ETF is like a synthetic company. So you have a company like Amazon or Microsoft or something like that, right? That's the company that generates the income. They sell stuff to you, therefore they create stuff, they make stuff. Tesla makes cars, so they are the engine that makes the product that creates the income, right? So if you're trading a stock, you are trading an engine that creates income. Well, how does an ETF create income? Well, they do the same thing. They buy a basket of stocks and they put them all in there so that when you buy the ETF, you're not just buying Tesla or you're not just buying Microsoft, you're buying a little bit of everything that's in there. Okay, so the QQQs, for example, we trade those all the time, right? Or the S&P 500. The S&P has 500 different stocks in it, but it's an ETF. It's a basket of stocks. So how do they do that? Well, what they do is they buy up a whole bunch. They buy up all those 500 stocks, or in the Dow 30, they buy up those 30 stocks. They buy up a whole bunch of them, put them into a basket. Now they have what they call a closed basket. Okay. So that doesn't change. And then they go out and they start buying and selling the stocks based on that basket of stocks, which is a whole bunch of little engines in there making money. And that's how the engines make money and give value to the ETF. So in the case of Bitcoin, they created an ETF. That means that you have the buy the rumor, sell the fact. You've ever heard that? Or buy the rumor, sell the news. I like to call it buy the rumor, sell the fact, because half the time, as we all know, news nowadays is not fact. News nowadays is the rumor. And I hear people say, buy the rumor, sell the news. And I'm like, no. Buy the rumor, sell the fact. The news is the rumor. All right. They lie to you in the news. We've all learned that. The news, you can't trust the news. If it's in the news, it ain't worth knowing in this industry. So don't buy the rumor, sell the news, because the news is the rumor. So if you hear it in the news, it's probably lying to you. And you got to think about it like that. These guys go into the news to manipulate. Oh man, I am learning so much about manipulation of the markets. It's just unreal. You're going to see in Pit News Magazine, I have an interview with a guy that it's just blowing me away. A lot of this stuff I kind of knew. It was in the soup, and I've been around a long time, and I've known it. But to have somebody come right out of the institutional industry and say, I'll tell you all this stuff, Lan, but you can't give anybody my name. I ain't going to tell you my name. You can't give them my identity. You got to keep it secret. And I'm like, hey, Pit News Magazine, man. We're a small magazine. It ain't going to go nowhere. I just tell my buddies and my pals what you're about to tell me. So I got an interview in Pit News Magazine, and it's going to be a multi-part interview because I talked to this guy forever and trying to write it all down, right? Record the interview and then write it into an article. So it's really cool. And he's like, I'll tell you what we do in the financial industry. We manipulate the living shit out of everybody. And the news is the lie. All right. Buy the rumor, sell the fact. Not buy the rumor, sell the news, because the news is the rumor. They go to the news to tell you to buy things that they want you to buy because they already own it. All right. And then you drive it up, they get rich, and then they sell, and then it falls back down and you hang on to it because you think, well, I'm going to buy it, hold on to it, right? And then they sell out at the top and you're left holding the bag. You lose all your money. So kind of the idea here is that Bitcoin has the buy the rumor, sell the fact problem. So this market has been run up, and in the futures market, we only have a very small history because we just started trading it not very long ago, right? We started trading it back in November of 2023. So this is just what's happened in the last November 2023. But this market has really just run up in with all of this rumor that they were going to create an ETF. Well, everybody thought that once the ETF was created, that the thing would go to the moon. And I was kind of in that camp. I was buying it up. I ended up buying it up. I bought a little bit, but I just had it on automatic buy, and I was just buying. So I dollar cost averaged into this thing as they were getting ready to do this ETF, thinking that we'd have a big run. And then it flushed. It comes tanking right back down after the ETF was released. And so then you're thinking, well, why did it tank? Why didn't it fall? Well, because during the buildup to the ETF's release, remember, the ETF has to buy whoever's going to create the ETF, whether it's BlackRock or some other giant institution, right? They're going to have to buy up all of that Bitcoin before they can create the ETF because it's a closed system. They have to own it before they can create the ETF. So in the case of Bitcoin, the reason it ran up like this so hard was because they were buying it up so that they could create the ETF. Once the ETF is released, they're not buying it anymore. The giant institution is no longer trading that ETF. Now they've got it. So that was the buy the rumor. The rumor is we're going to have an ETF of Bitcoin. And so the big institutions who are trying to create these ETFs had to buy up a lot of Bitcoin to create their ETF. That's why we had the big bullish run in the market. Now, as soon as the ETF is released, well, they're not buying it anymore. Who's buying the ETF? You and me, the retail traders, right? And so the retail traders now have it. And then the people who have the ETF, they bought all the Bitcoin, they put it into the ETF, and then they're given shares. So now they have shares of their ETFs. They have the right to go and sell against that opening new ETF. And so if a bunch of them decided that, well, hell, I just want to make a whole bunch of money off of the ETF that I just put a whole bunch of shares in there, the market flushes because they sold out. They sold their shares, not the Bitcoin. The Bitcoin is a closed system. It's sitting inside the ETF. They now have shares against that ETF. And so they wanted to make their money back from that bunch of Bitcoin that's in the ETF. So they're giving shares against that little engine, and they sell them out, and down goes the market. And that's why you get the buy the rumor, sell the fact, buy the rumor, sell the news. Don't call it that anymore. Well, I'm on a campaign to change that. Buy the rumor, sell the fact. Don't buy the rumor, sell the news, because the news is the rumor. All right. The news is the rumor. You go listen to this guy talk to you about what they do in these institutions to manipulate the markets. The news is the rumor. You go on to, how many times have you watched Jim Cramer? I mean, we all like to watch Jim Cramer. He's exciting, right? Honk, honk, oh, bye, bye, sell, sell, bear, bear. You get excited about that kind of stuff, I guess. Some people, it gets a little bit too much for me. I can't watch him. But he sends out an email and he has all of his fundamental reasons. He's a big fundamental analyst. He doesn't do any technical analysis. Actually, he started doing a little technical analysis. If you go watch his show, every once in a while, he'll have Carly Garner on there. You guys remember Carly Garner? She's my old student. She's the one who wrote this book that we love, right? I have to step out of the thing. Right? This is her book on options. She was one of my students. And so every now and again, very proud teacher that I taught her. She's now on CNBC with one of my students is on the news with Jim Cramer, but she does technical analysis with him because, that's what we do. I taught her technical analysis. She's a technical analyst. She's also a fundamental analyst. We all are. But to a larger degree were technical analysts. And so she goes on, and you'll see her on with Kramer every now doing some technical analysis. And he calls it off the charts with Carly Garner. And so anyway, he's doing a little bit of more technical analysis, but he's a fundamental analyst. And you'll see that when he's on there, he has CEOs come on to his show all the time, doesn't he? CEO of this company, CEO of this company. Hey, we're going to ask you, is your stock going to do well or is it going to do poorly? Oh, it's going to do really good. And then it flushes and goes to the toilet. And you're like, what the heck? I bought some stock from this guy because he said it was going to do really good on Kramer, and then it flushed to the toilet. You were part of the news. That's why they came and did that, to get you to buy into their stock because they're having problems. They needed a boost. He's out promoting his, what is a CEO of a company? They're their number one salesman. He's out there trying to sell the company, trying to sell the products, trying to sell, right? So if he goes on Kramer, you think he's going to go on there and say, don't buy my product. It sucks. We're really having a hard time. Heck no, the reason he's on Kramer is because he's having a hard time. He's trying to sell his product so he can get you guys to buy it so he can have a good time. They're trying to pump their stock. That's why he's there. Sell the rumor. Don't. I don't know. That's why they laugh so much. There's actually even a group that follows Kramer, and they fade him. What does fading mean? It means they do everything the opposite of what he says. If he says to buy this, sell it, because it always falls. He's got such a bad track record of all of his recommendations on his little TV show that they've even actually got a fund where you can fade Kramer. Go look it up. I'm not joking. You can go Google it. All right. So enough of that. So we've had our little Sunday school lesson, my little lecture for the morning. Let's go see if we can do a little trading. I figure we could do a little trading in Bitcoin. It's been in the news, and so it's going to get a little pump here. And oh, look, while we were chatting away, it's taken off. So it came down this morning, had a little bit of a fall. You can see on the 2-minute chart, but it had the rally. So this is the rally on the 15-minute chart. You can see because of the news that they had on it yesterday. Had a little pullback. That's the little ABC pattern. And on the 15-minute chart, it's starting to rally once again. So we see this on a 2-minute chart. We're seeing the same thing here. We're getting the little, this is the reversal pattern, right, that we look for. I always tell you, don't chase the reversals. Reversals are really hard to try and catch because markets don't, well, the trend is your friend until it bends or ends. Now, that's not just a cute saying. We say it because it has a tendency to work, right? I mean, we all like to chase the reversals, because we want to be in at the very bottom of the chart. We want to get in right at the very bottom. I got to get the very closest thing to the bottom of the chart and go long, long, long and make all that money. So we keep trying to chase reversals. So every time you get an up arrow, you jump in. Every time you get an up arrow, you jump in. And you get knocked out, all the way down a downtrend. And at the end of the day, you look at it and you go, oh my hell, one big giant downtrend. And I lost money on this thing because I kept trying to capture the reversal, which was not a reversal. It was just a small pullback to trick all you guys into getting in, trick all of us guys, right? I don't want to not include myself because they trick me all the time too. That's what their job is, to trick us. So they trick us into the market and then they get out, and then they trick us into the market and then they get out, and they trick us into the market. By the end of the day, you're like, hey, hindsight's 2020. I would have just taken a short position and gone short, and made all that money. I've been rich beyond my wildest dreams. Well, it doesn't always work like that, right? At the end of the day, you look at a chart and you're like, man alive, that was the easiest thing in the world. I could have made $1 million, but you lost money on it. And you're like, what in the heck's wrong with me? Well, the reason you lost money is probably because you kept chasing the reversals. You didn't think in your mind, hey, the trend is my friend until it bends or ends, and the trend is up or down. How do you know if a trend is up or down? Well, you know a trend is up and down by higher highs and higher lows. If a market's making higher highs and higher lows, then it's uptrend. If it's making lower highs and lower lows, it's a downtrend. So that transition place from higher highs to higher lows and from lower highs to lower lows is called a head and shoulders formation. So let's draw that in there real quick. Bring it full screen, Lance, so everybody can see. So you have this technical analysis tool, right? We've already decided we want to trade Bitcoin. That's the fundamental side of it. What made you decide you want to trade Bitcoin today? Well, I heard some news. All right. I heard good news last night. It's in the news, and they said it's going to go up. If that's your fundamental analysis, whatever the decision was that made you do it. Now, you know, a more traditional fundamental analyst has a bunch of math formulas that they look at, right? So in stocks and stuff like that, they'll look at the PE ratio and all kinds of neat stuff. And I've got a whole list of all the formulas that fundamental analysts use. And so we'll talk about those in class tonight, because tonight is the Friday night class. So in class, we'll talk about all those formulas, and maybe we'll review those here in the lab on Monday, and I'll show you all those formulas. All right. And I'll show you, I'm going to show you a cheat. All right. I'm going to show you how to cheat. I'm going to show you a little secret on how you can get away with not having to know all those formulas. It's a little cheaty secret. All right. So I'm going to show you how to cheat in the stock market. Anytime you can cheat in the stock market legally, I mean, don't cheat illegally. There's some of those too. Don't do that. All right. But if anytime you can cheat, which is just getting extra knowledge that other people don't have, because anything everybody knows isn't worth knowing, right? We've heard that a million times. So we got to learn how to cheat. Got to get some extra knowledge. So we're going to get a little extra knowledge, and I'm going to show you a little cheat code in the game. You know, that's a game, just like when you're playing a video game, you got cheat codes. I'm going to show you some cheat codes. And so that's what technical analysis is, kind of the cheat codes of knowing when to buy into these fundamental markets that are doing well, or that you should get your news on. Okay. So in this case, the Bitcoin, we got some fundamental news that was positive, and so we thought we might trade it today. So that's our fundamental news. Now our technical news is, when do you get in? Higher highs and higher lows. So if a market comes in and it's coming down, making lower highs and lower lows like this, and then it turns around and starts making higher highs and higher lows like this, well, how do we know it switched from a downtrend to an uptrend? He's like, well, it's obvious, Lan. It turned around and started going back up. Well, it's not that simple. It's not that obvious, but it is that obvious. I mean, to some degree, right? You just kind of switch your direction of your higher highs and your higher lows. But in the process of doing that, we end up with this little pattern here. We call it a head and shoulders pattern, right here, 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 here. And so that ends up being let me come and bring this in so you can read it, so it's not over the top of each other. So that ends up being your left shoulder. That ends up being your neckline across that trend line, right? Across that neckline. That we call that the neckline. Then we have the lowest point is the head. And then we have the right shoulder, or the neckline. And then we have the right shoulder. And then as soon as we make a higher high, we're no longer in a downtrend. Oh my goodness, look, Lan, there's one right there. Is it as perfect and cute and pretty as the one I drew? No, but it's right there. It's just as obvious as the nose on your face, is it not? And actually, I'm going to change this. I'm going to come down here, and I'm going to move that neckline, because I like to have the neckline not be pointed up like that. I like it to be pointed down like that. There we go. So that's kind of our neckline. Now, if you draw your trend line all the way down, that's your natural trend line across those higher highs, right? So higher lows, higher highs. So you got lower highs, lower highs, lower highs, lower highs, lower lows, lower lows, lower lows, lower lows. We're in a downtrend. Now the market has switched, and it's changed from lower lows and lower highs to higher lows and higher highs. So this is where we're starting to see this market go back up. And so we're getting this natural trend line back up like that. So it's exactly what I just drew right here. See how I drew it like this? Now you see it in the actual market. Okay. So that's how you do technical analysis. That's called technical analysis. So we've got the fundamental news, the information that told us yesterday or last night, hey, Bitcoin should run today. It should rally tomorrow. There's, people are going to start buying it because it hits certain levels of support and resistance, or, those are also technical information, but it hit certain prices. And so people are going to start buying into Bitcoin again. Okay, let's go look at that, and we're going to watch Bitcoin and see if that actually happens. And it's kind of turning right now, right? We're getting lower highs. Now this is on a very small time frame. This is a range bar 6. So we have to remember that this is a little tiny time frame. And in this Bitcoin, we are actually in the micro, because we don't have a mini Bitcoin. We have a giant Bitcoin, and then we have a micro Bitcoin. We don't have a mini Bitcoin. I wish we did, but we don't. So we're going to come in here, clean up all this stuff. And let me show you with the dollar calculator, from this very low right here to this very high right there, that was only $41. All right, so that's a big move for 41 bucks. So what we do is we have to go out, and usually, you can try and trade this. I mean, there's nothing wrong with getting in here and trading on these little tiny time frames. You can trade multiple contracts, right? But that's $14 from that yellow bar bolt, from that yellow crossover to kind of where you might have got out up here. if you got stopped out. That's only $14. And that's okay. I mean, you trade with a small account. There's nothing wrong with trading small, but it would be nice if it was just a little bit bigger, right? So trade multiple contracts, but then you have to trade, you get multiple commissions. So if it was one contract was a little bit bigger, we could save on commissions and get more money, but that's just the way they built it. So now we're going to come in here and take a look at a 2-minute chart because that's a range bar 6 chart. Let's go look at a 2-minute chart. So now if we got a 2-minute chart, maybe what we would do is we would stay in this market a little bit longer and we'd say, okay, well, I got in down here and I rode this thing all the way to the top. Okay, that's $121. All right, that's a little better. So 4 to 6, 5, 6. So in a 2-hour time frame, basically, you could have made $121. Now that's better, right? That's a lot better. So when you're trading these micros, you have to be mindful. You don't want to be myopically down here on these little tiny time frames like we do when we're trading the minis. So the minis, it'd be 10 times bigger, right? So that would have been a little move like that would have been $170. And that would have been in, what, from 7:30 to 7:45. So what, about 15 minutes, 20 minutes, in about a 20-minute time frame, you could have made $175. Now we would have had to done that over in the Russell, the Dow, the NASDAQ, or the S&P 500, right? So into one of those mini indexes to make that kind of money. We don't have that here on the Bitcoin. We'd had to do 10 of them to do it in the Bitcoin. So that's why we go out to a longer term time frame and we say, well, okay, I'm not going to try and be so aggressive. I don't need to be so aggressive. I can try and catch a longer term trend and stay in it a little longer. So here's a 5-minute chart. We could even trade that one. And of course, when we're trading the micros, a lot of guys like to trade the 15-minute chart. There's a lot of guys that'll trade the, it's very common for guys to trade the 15-minute chart on the minis. There's nothing wrong with that. You can certainly trade these longer term time frames. It just depends on the size of your account. All right. So if you got a big account and you want to go for a longer trend and you're looking for a bigger trend move, well, you're going to take a bigger risk too. So it really depends on the size of your account. And if you remember, we have the mathematics that we talk about in that all the time. So where is that? I'll show you what I'm talking about here. So we have our rules of the road. Is this the one is this our rule of the road I'm trying to come up with? Nope. Oh, back up, land. Right here. So this is your risk management strategy. So if we subscribe to this idea, this concept, then we're going to try and set 1% to 5% of our account equity value. So we have $10,000 account multiplied by 5%. That means 500 per day is our goal. So we're trying to make $500 a day if we have a $10,000 account, if we're trying to make 5%, right? 5% per day. Now you see my little spreadsheet I put on there 1% because I'm trying to be very conservative, very careful with you guys. We want to make 1% and we're happy, right? So we need to set a daily max loss too, how much we're going to lose. Now yesterday we went hog wild and went crazy. And I did that because I wanted to teach 2 lessons. I want to try another lesson today. I don't know if we'll get to it, to follow up on what we did yesterday, but we went hog wild just trying to show you that you can overtrade. And I kind of, jumped into that not thinking that's what I was going to do, but then we did it anyway. So now you're going to set your daily max loss. So in your daily max loss, we're going to have 2 days of daily profit target. So we're going to take our $500 times 2, and that's $1,000. So that's the max we can lose in a day. And if we lost that would give us 10 days. So we could have 10 days of trading and lose our max loss every single day for 10 days. Well, then we'd be out of money and we'd have blown up our account. But rather than blowing up our account in one day, like we tried to do yesterday, right? So rather than blowing your account up in one day, if you'll limit yourself to, 2 days, then because that's what that is, it's just taking your profits, your goal of 1 to 5%, in this case, 5%. If we're going to make $500 a day, and that's our goal, we only want to set ourselves back by having a bad day 2 days, so that we don't set ourselves back 4, 5, 6, 8, 10 days. And it takes us 8 or 10 days of hitting our max profit to get back to break even. So that's the whole idea, right? We want to kind of, once we're having a bad day, we need to recognize that and stop trading, walk away, get away from that thing and go do something else, so that we don't blow our account up, so we can come back the next day and start digging ourselves out of a smaller hole than a great big giant hole. So set our max per trade loss, calculate position size. And so if you have a $10,000 account, you're going to take a 2% risk on each trade. That's $200. All right. Now we might not want to take a full 2% risk. These are just some standard numbers. You might want to take a 1% risk, but it depends on the market that you're trading, right? So you can't just come in and say, well, it's a lens said use a 2% risk. I'm going to use a 2% risk, because the amount of risk that you're going to use on the NASDAQ is going to be way different than the risk you're going to use on the Russell. Because if we're using a range bar 6, for example, right, a range bar 6 on the NASDAQ might be $300, $400, whereas a range bar 6 on the Russell might only be $60. So you can't say, well, I'm going to just risk, $200. That doesn't work. You have to risk 2 price bars, or your entry bar and 1 price bar back for your stop, and whatever that is has to fall within your mathematical model. So if that 1 price bar, if you're trading a range bar 6 and a range bar 6, or in this case a 15-minute chart, if you're trading a 15-minute chart, you get in and you got 1 price bar back as your stop, and that's $600. Well, your account doesn't accommodate that. You can't trade that market on that time frame. You can't take that big of a risk, because it's going to blow your risk reward management strategy out of the water. Does that make sense? So you have to take into consideration how big the risk is on the market that you're trading. And if it's too big of a risk, you can't trade that market. So you have to find markets that fall within the amount of money you've got to trade and the mathematical model that you've decided upon. So if stop loss placement exceeds 200, don't take the trade. If stop loss placement can accommodate, take a larger position size. So if our accommodation of $200, 1 price bar back from the entry bar is only $50, well, heck, we got $200 we can risk based on our risk reward profile. We could take 4 positions. Well, if you got a big account, you're in a 15-minute chart, and your risk profile can say that you can lose $1,000 and still only have that be within the margin of error of 1 to 5% of your account. Well, you can take 10 contracts, 15 contracts on a 15-minute chart. And if there's some of those guys out there doing that, it's because they've got monster accounts, and that's where they build themselves up to, and that's how they're doing that. And I make fun of them all the time, but if they're to that level, then hey, that's what we do here too, right? But if we're starting with a small account, we can't just run out there and say, well, that guy's trading 15 contracts on a 15-minute chart, so that's what I'm going to do too with my $5,000 account. You're going to kill yourself. You can't do that. He's got that ability because he's got that size account. He's built himself up over time to have an account and the skill and the ability to be able to trade 15 contracts on a 15-minute chart. And it's okay for him, because if he loses, it's part of his risk management strategy, and he's within the calculated amount that he needs to be, and he can do that. All right. But if we're in here, when we're doing a $10,000 account, we can't do that. We can't go with 15 contracts in a 15-minute chart. We'd kill ourselves. All right. So that's what that's all about. So set max account value. So if you're, this is my profit taking side too. If you want to get to a point where you're going to be doing 15 contracts on a 15-minute chart, you're going to have a big account, and this is not going to work for you. You're going to have to change this, right? $50,000 is still probably not enough to do that and still stay within the realm of what we're talking here. But if you have a $50,000 account, I think you should start taking money out. And this is how you take money out of the market. And that's one of the problems with a lot of traders, is they won't take money out. You got to take money out. You don't want these. This is a day trading. This is a high aggressive trading strategy. You don't want a lot of money in here at risk. You don't want to build up $1 million account in your trading profile. Not that you can't. You certainly can. You can do whatever you want. My suggestion would be that you have a max account size, whether that's 50,000, 25,000, whether it's, I've had mine be around 25,000 for a long time. I like 25. I like 50,000. If you can get it up to 50,000, I like to pull it back out. But let's say you have a $50,000 quarterly payout, any dollar amount over 50K. Dollar amount payout every 10K or over 50,000, over 50,000. So it doesn't have to be quarterly. It can just be any dollar amount. So you can do one or the other. Every quarter, every 3 months, you pull out anything over 50,000. If there's not anything over 50,000, obviously you don't get paid that quarter. Or you can do it the other way around. You can say, every time I make $5,000 over by 50,000, I'm going to take that $5,000 out. And then what do we do with it? This is our income source. This is what I try to explain to people. Day trading is your job. The whole point is to replace your income of however you're making money at other places, or to maybe just supplement it. I mean, in the beginning, you certainly don't want to just say, well, I'm going to be a day trader today and it's my new job. And I got an interview with Lan, and he says that all I have to do is just get the right software, put a little bit of money in there, and I can quit my job and be rich, rich, rich beyond my wildest dreams. And I can just be a day trader for a living. It doesn't work that way. I could say the same thing about being a doctor. Oh, hey, I think, oh, there's a hospital over there. I saw it once. I think I'll walk in there and tell those guys I want to be a doctor. And I'll just, quit my job here at Walmart and I'll go over there and be a doctor because that's what I want to do. I want to be a doctor. And so I just walk in there and they'll give me a job being a doctor because I bought me a scalpel. I went down as I left Walmart. I grabbed one off the shelf, checked it out, got me a scalpel. I'm now a doctor. Because I got the right tool, right? I got the tool. So now I'll just go be a doctor and make a whole lot more money. Doesn't work like that. You can't just suddenly decide that you want to be a doctor without any education, without any training, without any practice. Who's going to let you cut open their brain and be a brain surgeon if you've never done it before, or if you've never had any practice or never education? You're not going to be a doctor with just because you got a scalpel. Right? Same thing being a day trader. Day trading is a career. It's not just something that you decide you're going to pick up and go do, like, shoveling ditches. The reason people shovel ditches, because we need ditches. That's important. Don't want to downplay ditches. Ditches are very important, but you don't need to have a whole lot of education to shovel ditches. Can we all agree on that? All right. So the whole idea is that you got to have a little bit of education, a little knowledge, a little practice so that you can be a good, what to do with that scalpel. Because track and trade is one hell of a scalpel. It's a pretty damn fancy scalpel. All right. You can cut both ways. It cuts both ways. You can make a lot of money with this scalpel. You can also cut yourself with this scalpel. So you got to have training and education and knowledge and understanding. And I know you all know that. That's why you're here. You're trying to get a little of that. So I'm preaching to the choir at this point. So the whole point of this is that we need to have some sort of a risk management strategy when we start trading these markets so that we don't do what we did yesterday, which was a perfect example of what a lot of traders do when they first get in, right? They get so excited and every little move and they get FOMO and they want to trade and they want to get in and they want to do this, they want to do that. Oh, I got myself a scalpel and I'm ready to go cut some people. Let's go cut some people. All right. So look at this. Beautiful. Drive 1, drive 2, drive 3. Counter trend. And you think it doesn't work. You're like, this technical analysis stuff doesn't work. I'm just going to be a fundamental analysis. Well, you could do that too, because they both work. But I think it's better if you can do them both together at the same time, right? We use the fundamental analysis to help us know what to trade, and then we use the technical analysis to know when to trade. So it's a what and a when. And the when is very important. The what, that's very important too. But I'm going to teach you some tricks on knowing when to trade or what to trade. What to trade, in my opinion, is the easy part. The when to trade is the hard part. So the what to trade is easy, in my opinion. I don't want to downplay it. Guys study their whole lives to be good what to trade guys. And we need those what to trade guys. Those are very important guys because they tell us what to trade. But they've done such a good job, they've kind of put themselves out of work. They've done such a good job, we don't need them anymore because we can just do when to trade because they've already told us what to trade and they put it in the markets. So what do we trade? Well, I don't have a whole lot of choices, especially in the futures market. If I'm going to trade what to trade, what am I going to trade? Well, I got 4 things to choose from. These are what to trade. They've already chosen that for me. That's my cheat code. I don't have to go out and decide what to trade because they've already done all that fundamental analysis to tell me what to trade. They've picked the best 30 stocks. They've picked the best 500 stocks. There's 4,000 stocks in the stock market. Well, which one do I trade? Well, they've told you what the 30 very best stocks in the whole stock market are. They're right there. The Dow 30. The 30 best stocks in the whole 4,000 stock market has been picked for you by their fundamental analysis and all their mathematical modeling. And they told you they're right there. I don't have to know all that mathematical fundamental analysis of all the PE ratios and all that stuff. Why? Because really smart people have already done it for me and told me, oh, look, those are the 30 best. And if another one comes in and is better than one of the one that's in there that's 30, you know what they do? They take the one out that they don't like and they put the other one in there. I don't have to do that. They do that for me. So all that's already done. So I don't have to choose. I don't have to be a great fundamental analyst. I don't have to know all those mathematical formulas. Doesn't mean it doesn't need to be done. It certainly does. It just doesn't have to be done by me. What I need to do is not know what to trade because I already know what to trade. I know to trade the Dow. It's a little basket of the 30 very best stocks in the whole world. I have the Russell right here. They've already picked the 2,000 very best small cap stocks in the whole world. They've done that for me, and they put them into a little basket for me. And they said, those are great stocks. We'll move them out of there if they're not great, and we'll put another one great back in, right? So I already know what to trade. All I need to do is figure out when to trade it. So that's why you have fundamental analysis, what to trade, technical analysis, when to trade. So that's how we do the technical analysis. And that's why we do all of these, triangle, wedge formation, head and shoulders formation, trend lines, spider webs, Elliott wave, Fibonacci. That's what all that stuff is. It's when to trade these really great stocks. Now, if you want to go out and say, hey, I want to trade something other than the Dow 30. The Dow 30 are the best stocks in the whole world. All right. The NASDAQ 100 are the very best tech stocks in the whole world. Well, I want to trade something other than the very best. Okay. I want to trade something that's got a possibility of going up 1,000% because Microsoft is not going to do that. Microsoft is never going to go up 1,000% in one day, right? It's not going to happen. What would have to happen for Microsoft to go up 1,000% in one day? Right? It's lucky if it can go up 1% in a week or 5%, 10% in a year, right? If we got 10% in Microsoft in a year, we'd be like, woohoo, right? So you're like, I want to make 10% a day. I want to make 100% a day. Well, you're going to have to go into some really wacky stocks, right? And they're going to be off the rails type of stocks that you're not going to, you're going to have to do some fundamental analysis. You're going to have to do some news reports. You're going to have to find out these little companies that might take off and go to the moon because they invented some new drug or something, right? And then you can go and trade that, and you can catch those little, what we call unicorns, right? So you can go chasing unicorns if you want. So go unicorn chasing and try and make some money there. There's nothing wrong with that. You can say, okay, I got a core amount of money that I want to invest, and my little pyramid of how much I want to invest, I'm going to invest that in unicorns. So let's go trade some unicorns. Okay, fine. Allocate some money to that and go chase unicorns if you want to. It's certainly fine. But the fundamental analysts out there, all these great, wonderful people on Wall Street have already picked for us the very best stocks in the whole world, created baskets for us. Here they are. You want to know what the best 30 stocks are to trade? You're like, Lan, I don't know what stock to pick. Just go look at the Dow 30 and pick the 30 that are out of there and don't ever leave that. That's what I do. In my stock portfolio, if you go over to my stock portfolio, it's almost got nothing in it except for what's in the top in the NASDAQ and the Dow. The top stocks in NASDAQ and Dow, which also happen to be overlaid with what's the top stocks in the S&P 500. So the top 10, 15 stocks in the S&P, Dow, and NASDAQ, if you go look at my portfolio over the last 5 years, I probably haven't traded hardly anything outside of that little small basket of stocks. That's all I ever trade for my long-term growth potential of building my position. Now, my son, Ben, he's starting to move me around, get me do a little bit of stuff. He comes to me and says, hey, Dad, we ought to do a little bit of a diversification. We're going to help you get into some bonds. Get a little bit, you're getting a little old there. Your hair is turning gray. What hair you got left is gray. So why don't we help you, do a little bit more conservative trading at this point? I'm like, me? Conservative trading? I don't even know what that word means. So I've been an aggressive trader my whole life. He says, yeah, but you're getting older and you got this money saved up and you got all this money sitting over there and it's really high risk. And I don't want to have to be, giving you money out of my account because you lost it all in Bitcoin. So I'm going to teach you how to put some stuff in bonds. And so he's like, let's move some stuff in bonds. And so we're going to do a little bit of that, a little diversification. And I'll show you what his plans are. And I've got some bonds over here that I want to show you. And we're going to pull that up here in just a minute. But I wanted to talk a little bit about, wanted to see if we couldn't get an order going. The Dow's kind of flat. It's not doing anything. We didn't look at the news. Man, I've just been lecturing and lecturing today. Hope you guys were good with a lecture. Let's see. Where's our news? There it is. All right, news. Let's look at the news. Refresh. Today is Friday. So 6:30 this morning, we had core PCE purchasing. Isn't PCE the purchasing Or if I got that backwards. Core PCE excludes the energy previous. Yeah, it's the PCE. What does PCE stand for? I forgot. I thought that was Purchasing Managers Index. That's not the Purchasing Managers Index. I'm trying to jog my memory what PCE stands for. Core Price Index. That's what it is. It's core price index. All right. So core prices. Let's go back up plan. All right. 6:30 this morning, we had the price index month over month, and we had personal income month over month, and then we had personal spending month over month. So how did those turn out? The forecast was 3. Forecast was 2. We ended up with 2. Forecast was 3. We ended up with 3. Forecast was 3. We ended up with 7. So personal spending was much higher. People are spending more. That always makes me want to go look and see how much money is getting put on credit cards. More people are spending, they're probably buying more credit cards, putting more money on credit cards. PCE price index month over month, but right now it's 8 o'clock. At 8 o'clock we had home spending. 6:30 was the big mover. Pending home sales. Personal consumer, is that what that is? Personal consumer price index, I think. Baker Hughes oil rigs are coming on at 11. We could go trade crude oil. Pending home sales are at 8 o'clock. Oh, that was 20 minutes ago. Did that move the market at all? 0.7 and 8.3. Oh, the forecast was 0.7. The consensus 1.5. It was 8.3. Pending home sales in the United States soared 8.3% month over month in December of 2023, beating a forecast of a 1.5 increase and rebounding from a reversal of a 0.3 fall in November. Well, that's good. I'm actually getting ready to buy in my real estate company. I have a real estate company. We're buying another duplex. So we sent in an offer for a duplex yesterday. So we're buying another duplex in my real estate company. That's going to be fun. Isn't interest rates too high, Lan? Why are you buying right now in real estate? I thought everybody was sitting aside on real estate. Yeah, they are, which is making a good buying opportunities. We're going in there and beating these people up and said, hey, interest rates are too high. This little duplex has been sitting on the market now for almost 6 months. We're going to knock the price way down, but you're going to be paying a higher interest rate. Yeah, 1 or 2 ticks. Who cares? 1 or 2 ticks. We've knocked the price down way off what he wanted, made him an offer. We think he's going to take it. We'll have ourselves a nice little unit, way cheaper than what it was on the market for. And that'll compensate for the interest. And then when the interest rate comes down, we'll refinance and we'll be in good shape. It's already going to be an income property. Boom. Right off the bat. As soon as the minute we buy it, it's going to be an income property making us money. So we're pretty happy about that. Oh, that's just a little side note. I apologize for getting distracted. But that's the housing unit. So people are starting to buy houses again. So, okay, what are we watching? We're just watching a dead market. This is the indexes. Let's go back over to Bitcoin. It was moving a little bit better. And then we're going to pull up those bonds I want to show you that Ben's having me move into. Put some money in bonds, Dad. Don't be quite so aggressive. Calm down a little. You're getting old. You're getting gray. I don't want you taking all these high risks anymore. Okay, Ben. So Bitcoin's peaking out up there, isn't it? That's exactly what we'd expect off of that high point on the third drive high. Why do you keep talking about the third drive, Lan? What is the third drive? That's the Elliott wave. What? An Elliott wave? That sounds like reading tea leaves. Well, if you want to call it that, that's kind of what it is. That's what technical analysis is. It's reading the charts, reading the price. All fundamental information is built into the price, right? The reason a lot of technical analysts aren't fundamental analysts is because they figure that we don't need to be. All that fundamental stuff is in the price of the market. It is in price, and that's what a chart is. So that's why if we learn how to read the chart, we can understand the fundamental side of the market just by looking at the technical side, by looking at the chart itself. Now, when I'm talking to this institutional trader, the guy comes to us from a large hedge fund company, and he tells us how these giant companies trade their billions and billions of dollars. and how they manipulate the markets, you learn that this is all a process that they use in their trading. All right. The reason markets move like this is because of the algorithms that they create that do what they want to do when they're trading. So if you learn the processes of what they do when they trade, you know what the markets are doing and you can identify them. And so that's why markets go through these wave patterns, because they're all being manipulated or traded. I mean, I call it manipulation, but it's not really manipulation. It's just their strategy. It's their trading strategy. So if you got somebody who's a giant company that's trading billions of dollars, well, how do they trade? Wouldn't you want to know that? I only have I have $50,000 in my retirement account. I'm going to move those markets. No, you're not. Your $50,000 is like, that's like toilet paper to these guys. All right. So if you got a $50,000 account or $100,000 account, or let's say you got a $2, 3, 4, $5 million, you're still toilet paper to these guys. And so you're like, well, I ought to figure out how these guys trade who have billion-dollar accounts, $500 million. They got to put $10 million into the market today. They got to buy $10 million worth of shares, or they got to liquidate $10 million worth of shares today. How do they do that? What's the process? What happens to a market when those guys start doing that? Well, this interview that we're doing in Pit News Magazine, it's in the February issue, talks a little bit about that. So, not surprising. Some of you guys know and are familiar with, because I've already taught, or you've been in my classes, you know about the Wyckoff theory, right? So he talks about that, and he says that's what we do. And then he says that's kind of there's the modern day version of it, because when Wyckoff come out with his Wyckoff theory, he was telling you how things were done back in the olden days. But he's like, it's basically the same concept. It's just now all electronic. It's all done with algorithms, and we just programmed all that stuff in his algorithms. And he's telling me, he's like, most of the stuff we do is not trading anymore. It's trading. It's choosing which algorithm to run. Oh, you're in this state. Okay, you run this algorithm, and then they just turn it on, and it goes, and then does their thing. And then, oh, okay, you're done there. Okay, we turn on this algorithm, and then this algorithm goes out and does the thing. Oh, you hit your targets on that one. Turn that algorithm off and go turn this algorithm on. Which algorithm are you going to run on this market? Which algorithm are you going to run on that market? That's what these big traders do. They don't really sit there and go, oh, it's breaking above a previous high. Oh, it's doing this. Oh, it's doing that. Now they do some of that because they got to know when to turn on the algorithm, right? Which market to turn on the algorithm. So they are still traders, and they're still looking at the technical analysis. Surprisingly enough, he does say they do technical analysis, and they're reading the markets kind of like we do, but they read them backwards from us, very much backwards. And that's kind of what the Wyckoff theory is all about, right? And he's like, absolutely, that's what we do. He says, we don't use the Wyckoff theory. We are the Wyckoff theory. I'm telling you what's in the article. You got to read it. It's just amazing. Listen to it, because we're going to have it recorded. You don't even have to read it. It's in Pit News Magazine. You're going to be able to listen to it. So if you don't have Pit News Magazine, heck, you can get it for $1. Go over to pitnews.com and pick it up for $1, and you can have this amazing interview that's going to be in the February issue. So what are we doing here? All right, we've been watching this market. It's going a little bit sideways right now. We haven't been going crazy. Yesterday we went crazy and traded way too much. Today we've been going lecture land, and it's not trading enough. So I apologize for not getting into any markets. We're getting a few little bumps in here, aren't we? Little trends. It obviously doesn't want to go up anymore. So we're going to be bearish on this market and look for an opportunity to take a short position and see if it's not going to come back down to the magic blue rubber band. This market's not very big, so you could say, well, I'm willing to risk a couple bucks on this thing, take a short position, put your stop above that high, and just let it kind of coast on down and see if it's not just going to give us a little 50% retracement over here. We could do that, right? So that's kind of where we would look or anticipate this market coming back down into this Fibonacci sweet spot somewhere. It's not very far. This is a small market. So we've got kind of this little topping pattern up here, and we are bearish on the market. We could put a couple of them in here and see if that's going to go, right? Now we're going to come in here. We'll put a stop in here. What am I doing? Land, get careful. Stop. Don't be crazy. We'll put one right here just behind this, not behind the high. Yeah, we'll put it behind, kind of more along the lines of where those yellow dots are. We'll just put it just right behind the yellow dots. We'll put another stop up here a little bit farther. We'll put a couple of them up here. How's that? We'll go not with 3. What am I doing here? I only just want to do 1. So we'll just stop out right up in here. And we're going to let this market just kind of dance around a little bit. And we're going to put another couple of them up here. Now remember, I want to stop. So if it does go up and break new highs, we'll just get out. So we are looking forward to just continue to kind of drift down into this region here. We'll just let that go for a little while. We're not going to move these stops. We're not going to trail them. We're just going to let that go. And we can come down here and say, well, if it does come down here and test this blue line, which is the VWAP, we'll come down here and say we'll take our profits off at the VWAP right there. Otherwise, we'll just stop ourselves out and lose a couple bucks. That's kind of a nice little strategy, right? A 2-to-1 risk versus reward ratio, or a 1-to-2 risk versus reward ratio. I want to go through and I want to do what we did yesterday. I want to do it again. You're like, what? You blew your account up yesterday. What do you want to do? No, we're kind of doing it as a lesson. I kind of wanted to show you something. And if you realize and remember, as we went through that whole thing, we were like, man, you're always taking your stops, but you never take your profits. David Duty trades kind of in that, I mean, not that wild and crazy. We were doing a little wild and crazy yesterday, right? We were having fun. But what if we reversed the 2-to-1 risk or the 1-to-2 risk versus reward ratio and made it a 1-to-2 risk, a 2-to-1 risk versus reward ratio? So what if we risk 2 for 1 instead of 1 for 2? And what if we just reversed that? And so instead of getting stopped out all the time with a close stop, we got limited out with a close limit. And so we take a lot of trades, but we take very small scalps and we risk double of what we're scalping. Well, if we were right more often than we're wrong, which is what we were yesterday, we were wrong more often than we were right. We were actually right. We just didn't get any runners, right? We were in there and we were like, well, if the thing runs, we'll get a nice run out of it. But it never did run. It would pop a little bit up and then it would turn around and go down and stop us out. It would pop again up, run down and stop us out. So what if we reversed our 2-to-1 risk versus reward ratio, or 1-to-2, and made it a 2-to-1? So we risked 2 for 1 profit. Well, that would put our limit order very close, right? 12, and our stop at 24, as opposed to the other way around. And what if the market all it had to do was pop up 12, just like we were getting stopped out? So instead of getting stopped out, we got stopped in, basically, right? We took the profit as where we'd rather otherwise get stopped out. That's just kind of something to play with. You guys can go try that on your own if you would like. But a lot of people trade like that. They trade with a 2-to-1 risk versus reward ratio instead of a 1-to-2 risk versus reward ratio. So I want to go and do that. I don't think we're going to have time today because I got lecture land going. But I do want to go and talk about these bonds. So I've got this. I got to pull these bonds up. I got them all prepared. I prepared a nice bond lesson for you. And now I've been kind of I got going on the lecture land. Hopefully you learned something today, though. Let's bring this over here for a second. Okay. All right. How do we get that up there again? Okay. Man, I can't see your trade. I know. It's just going to sit back there for a minute. We can, now that I've done it like this, watch this. Boom. There it is. We can look at it real fast. Everything's good. Everything's kosher. Everything's happy. We're just going to kind of let it dance out there for a minute. All right. You don't have to be so aggressive when you're trading these micros. You have to trade bigger trends, right? Because there's not as much money in them. So you can stay in them longer. So we're trading that 15-minute chart rail, basically, right? And our stops are back behind the highs, and we're just going to kind of let it drift back down, see if it won't fall back down here. Come back down, test this blue line down here. If it does, we'll take it out. All right. So these are the bonds. Now, what's great about bonds is that you put your money into the bonds, and they're relatively stable. And the whole idea of a bond, right, bond trading, is that it's kind of like that rental property that I just bought. Okay, so I just bought me a new rental property, and I'm going to put some renters in there. Now, remember, when you have a rental property, you have intrinsic value and you have extrinsic value. Very similar to an option, right? Those of you who have been in the options class, we talked about intrinsic value and extrinsic value. You have two types of value that make up the value of a investment, whether it's real estate or an option, or in this case, a bond. All right. And even in the case of many stocks, you have two types of income. You have intrinsic value and you have extrinsic value. Intrinsic value is if I buy the stock at $25 and it goes up to $50, well, I have $25 of intrinsic value. Okay. If I buy real estate and I buy a house, or I buy a duplex, like I'm doing, right? We're in the process of buying our duplex. So I'm going to buy this duplex and I'm going to pay, let's say, $300,000 for it. So I got a duplex with $300,000. Well, what if I hold it for 10 years and it goes up to $400,000? Well, I'll have $100,000 of intrinsic value. In the meantime, I'm going to rent it. It's a duplex. I got two of them, so I can rent it out both sides, right? So now let's say I've got $3,000 of rent coming in every month off of this $300,000 duplex. So now I've got extrinsic value. Intrinsic value is the house itself, and it's going to increase in value over time or fall. I mean, markets go up and down, right? In the real estate, they don't always go up. Sometimes they go down. But that's not going to change my rent. My rent is my extrinsic value. And even if the house or the duplex drops in value by 50,000, let's say I buy it for 300,000, market goes crazy, that whatever happens, we have something bad in the economy go on, and the value of my home, the house or my duplex drops to 50,000, drops by 50,000 down to 250,000. Okay, my intrinsic value has gone down, but my extrinsic value, my rent, is still coming in. I still have my extrinsic value, right? So you have two types of value that make up a property. So let's say you go out and buy a piece of land. Well, there's no extrinsic value. It's like buying a savings account. And a lot of people will just use land as a savings account. I have land. I've got a bunch of land. Okay. There's no income source from it unless I put a horse on it and let somebody run their horse on it and give me, $100 a year to run their horse on it. That would be I have no intrinsic value or no extrinsic value on my land. So my land, in my mind, the way I think of land is it's just a savings account. I don't want to put the money in a bank because I'm not getting any interest, right? Because the interest rates were at zero. Now they've changed now, they're higher and you can get interest rates at a little better rate. And so, I'll buy less land as long as I can get interest rates above what I could get on my land. But the land has intrinsic value. I buy a piece of land for $100,000 and then it goes up in value over the next 10 years. Over the next 7 to 8 years, I would expect it to double, right? Possibly even double my investment. So if I hold a piece of land that I bought for $100,000 in 10 years, I should be able to sell it for $200,000. Well, that's a pretty good return on my money. That's better than I can get down here at Cash Valley Bank, right? Better than I can get over there at Zions. Better than I can get over there at Chase. I can't get that kind of return. So I put my money into a piece of land. I don't have any maintenance on it. It just sits there. It's a piece of dirt, right? I don't have to go over there and worry about tenants. I don't have to worry about plumbing. I don't have to worry about broken garbage disposals. I don't have to worry about lights. Nothing. I don't have to worry nothing. It's a hunk of ground. It's a savings account for me is what it is. All it's got is intrinsic value. There's no extrinsic value coming in on it. All right. So when we come over and we start looking at the stock market and we're like, well, how do we reproduce the things that we've got out in the real world, like a duplex, or I don't want to have a duplex land. There's got to be a better way. I don't want to worry about plumbing, and I don't have to worry about electrical, and I don't have to worry about taxes on the property, and I don't have to go out and worry about finding renters. How can I reproduce that in the financial markets? So that's what we do with the financial markets is we're coming in here and we're trying to reproduce what we've got out in the real world with our property, with our extrinsic and intrinsic value, and we try to reproduce that in the stock market so that we don't have to go out and deal with a hunk of dirt or with renters who have broken garbage disposals. So now if you take a bond, all right, and I've got a list of them here, and you guys should take your little cameras and take a photo of these. So grab your little iPhones, go up there and take a photo of these because these are some of the very best bond funds. And I'm going to go through, I got information on each one. I'm going to show you what the returns are. So if you come in and buy this bond fund right now at $77, that's your intrinsic value. Okay. That's your intrinsic value. You just bought a condo or you just bought a rental property. So buying into a bond is like buying a piece of rental property because you're going to have both an intrinsic value and an extrinsic value, because the extrinsic value is the return of your interest rate that you're going to get on your bond. Okay, now some are a little bit more aggressive, some are a little bit less aggressive. But again, it's those fundamental analysts, those guys like Ben. We don't have to worry about that. They're going to take care of the of all that crap. So this is a bond ETF, again, exchange traded fund, meaning it's a basket. They went out and bought a whole bunch of bonds and put them into this basket. So it's not just one bond, it's a whole bunch of bonds. So it's nicely diversified into a bunch of certain kinds of bonds, and they're going to manage that for us. Okay, so it's like a property manager. They're going to manage that in that ETF. We don't have to do that fundamental analysis. They're going to do that. If one of the bonds is bad, they take it out and they put another one in. All right, they replace it. So they are the ones who are constantly fixing and working on the ETF. They take care of that for us. All we have to do is trade the shares, and we buy the shares, so we have ownership of that bond, but we're not going to buy them and sell them like we might do a normal stock. We're just going to buy them and hold them. So just like the duplex that I just bought, I ain't going to sell it and buy it and sell it and buy it and sell it. I'm just going to buy it and own it. I own it. I'm going to own it for 10 years, right? 15 years maybe. So I'm going to keep that thing for a long time, and I'm just going to collect the intrinsic value. And I don't really care what the value of the house does. Now, I obviously kind of want it to go up. Obviously, over a period of time, I want that intrinsic value to increase, but that's not my big concern. I'm just going to buy the house, and then whatever it does, it does. So let's reproduce that concept in the stock market using this bond fund. We're going to buy the bond. We're going to buy the house. It's got intrinsic value. The intrinsic value is the $77.52 that it's currently trading at. If it goes up, yeah, I'll make intrinsic value, right? If it goes down, I lose intrinsic value. But if you'll notice, it's not very much. From the very top of that trend to the very bottom of that trend is only $5. It's not a huge move. It doesn't move a lot because it's a very stable bond, right? Now, if we come in here, which one of my HYGs is the one I'm on? So if we come in here now, what is the extrinsic value on this? What's the rent? How much rent do we get on it? Now let's think about, if I have a $300,000 property, and I have, let's say I charge $1,500 a piece. That's $3,000 that I'm making every month. So $3,000 against a $300,000 property, that's, roughly $30,000 a year. So I'm making about 10%, right, on my property. But I have taxes, I have the loan I have to pay off, I have all kinds of things in there that I have to deal with. I have to deal with renters, I have to hire a manager, I have to have expenses, I have to make sure that the toilet's not plugged, I have to make sure that when the lights go out, I go fix them, or electrical problems or whatever. I have to keep maintenance up on that thing. So I'm making 10% a year on my rental property, and I'm going, woohoo, 10% a year. That's pretty damn good. I'm awesome. I got me a real estate property making 10% a year on the extrinsic value on the rent. And I'm pretty happy about that, right? But if I come in here and put that same $300,000 into this bond, I now have my intrinsic value of the ownership of the bond, but I also have rent coming in because it's a bond, has rent coming in. So let's go over and look in my notes. And in my notes, I have a little bit of information. Grab your camera, take a picture of this. Okay, give you a second, but look at what the rent is. The rent is 5.73% a year. Now on my duplex, I'm making about 10%. So this is 5.73%, but I don't have any other issues with it. I don't have to go fix the toilet. I don't have to go fix nothing. I put my money in here. I own the bond, but the bond returns to me 5.73% on average every year. And I don't have to go fix toilets. Okay. So that's this bond. That's the whole idea. That's the whole idea of bonds, bond ownership. So let's come up here to BKLN Invesco. All right. So this one, we are going to say, let's go to the notes. And this one is returning an 8.72%. Look how stable it is. Let's come and clean this up a little bit. But look how stable it is. It's only $20. And over the last year, it's only moved. Basically, let's do that in a percentage. Chart, preferences. Price move, show text. What am I looking for? I want price move. 2%. So it's kind of fluctuated a 2% move over the year on my intrinsic value. All right. So over a year's period of time, it's only moved 2%. That's good. You want a bond to be stable. You don't really want it to big moves and fluctuations. That's the whole idea of a bond, right? Is that you're not looking for the intrinsic value to change much, but look at the extrinsic value. It's been averaging 8.72% extrinsic value. It's been paying you 8.72%. Let's say what's 8.72% of $100,000? Let's say you put $100,000 in there. Well, that would be $100,000 would be $8,072 every year, right? So if you have 100,000 times 8.72%, $8,720. Well, I could have done that in my head. Grab that calculator, Lan. So $8,722 on every $100,000 you have in your bond. And now, is that 8.72 guaranteed? No, it's not guaranteed, but it's a target that they have specified that they're going to kind of maintain, probably around 8.5 or 8% return on their money. And that's their goal. So they're going to kind of dial it in to try and get the bonds in there that are going to give them that 8.72%. And as they move bonds in and out of that basket of funds, and as those bonds, they make changes in there, which aren't going to be very many, so the bond is relatively stable, you're going to make 8.72%. So if you had 8,000 coming in how much do you need? So you could just reverse into that and say, well, if I'm making 8,700 on every $100,000, how much would I need in there to live off of? If you need $50,000 a year, you'd probably need, how much? $50,000 a year wouldn't take much, $500,000, and you could be making $50,000 a year on this bond. Just put it in here, and then you don't need a rental property. So that's what I'm doing. Ben's got me moving some of my assets around. My son is a financial analyst, and he's come to me and he says, Dad, you're getting old and long in the tooth. Let's set up some of these bonds for you. And he has a little formula that he likes to use. He says, your age should be how many bonds you have. So right now, I'm such an aggressive trader, and you guys all know me. I'm very aggressive. I've been an aggressive trader my whole life. My son is finally getting old enough to be, you're always proud when your son's smarter than you. And he's come up in the financial world, and he's coming to me and he's saying, Dad, we need to start looking at some different ways of analyzing what you're doing here. You got all this money and it's spread all over the place, and you just kind of got out. You got to start getting ready to retire. And so he says, you're 60 years old. You should have 60% of your assets in something stable like the bonds. And then you can put out of the other part, you can put 40%, and you can still do that and still be your aggressive trader and build your little hedge fund. But don't be building your little hedge fund at 60 years old with 100% of your money. You should be doing a little bit more conservative, and let's Dad start using 40% of your money to build your hedge fund over in the stock market, and let's put 60% of your money into the bonds, and you can just run your bonds as if think about it as like your real estate company. This is your extrinsic value and your intrinsic value. So I'm going to be making 8.72 on my extrinsic value, and my intrinsic value is just going to be the bond that I bought. All right. So different bonds have different amounts, and the higher the return, of course, is the higher the risk of the bond. So let's go through my bond list. So these are the bonds we're looking at. First one is BKLN. That's this one here. I like this one. This is a good one. It's got a high return. I'm a little bit more of an aggressive guy. You know me. So I'm going to go with a little bit more aggressive bond. So here we go. There's the Vanguard fund. This is the Vanguard Market Fund, and this is another one that you can get into. And if we go over here to the notes, take a picture of that one. There's a little bit about the Vanguard fund. It returns a 3.12% extrinsic value per year. Now, it's not nearly as high as the other one, but it's supposedly a little bit more stable. All right. It's been a little bit wilder. Look at it. It's kind of moving a little bit more. But that's your intrinsic value. So it's gone from $68 to $72, your intrinsic value. And it's going to move and fluctuate, but you don't really care about it because you're going to never sell it. You're just trying to live off the interest, right? Not that you can't sell it. You certainly can. If and when you buy more, you want to buy low, sell high. And we're going to teach you how to do that with technical analysis. And that's part of the next class that we're going to be in. We're going to go through technical analysis. We're going to learn how to get into markets and buy low, sell high. And so that's the whole idea of that one, right? We got tools that are going to help us make that. So we can buy. It's not that we don't want to pay attention to our intrinsic value on our bonds. Of course we do. But we're going to be strategic about buying into some of these things. So let's go to the next one. The next one is GOVT. GOVT. That's the iShares US Treasury bond. All right. So if you want to buy Treasury bonds, this is how you can do it in an ETF. You don't have to go over and do it on, bond.gov or whatever it is. You can do it over here in the stock market with an ETF, exchange traded fund, a basket of bond funds. They manage it, they buy them, they sell them. You don't have to do anything. All you have to do, because they created an ETF, right? They went and bought a whole bunch of them, stuck them in there. Now they're just letting you buy them and sell them. And there we go. Go to the preferences, not the preferences. Go to the notes tab. This is a little bit of information about that. And you can see it returns a 2.68%. So those are your bonds. Take a picture of that. Pull these up. These are your rental properties, all right? These are your rental properties. Now, you can do the same thing with an individual stock, all right? I don't want to downplay that. You can do the same thing with an individual stock, because an individual stock, many stocks have dividends that they pay, right? And that's what your intrinsic value is and your extrinsic value. So you buy Microsoft and then you live off the intrinsic value or the extrinsic value being the dividends that they pay out. So you can have a basket of stocks that you build yourself. And we're going to get into that, right? That's what part of this class is. We're going to get into building our own personal hedge fund. And part of what we're going to want to do is we're going to want to trade and build our own personal hedge fund around stocks that pay a nice intrinsic and not only an intrinsic value, but a nice extrinsic value. Now, a lot of stocks, we're looking for growth stocks. We're not really as interested in the extrinsic value. We don't really care about the extrinsic value nearly as much. In fact, we don't focus on it hardly at all when we're looking at a growth stock, because we're just interested in the intrinsic value and the growth. That's why the QQQs, which is the 100 shares of the high tech stocks, they don't pay very good dividends. Why? Because those are all growth stocks and they're growing. And so you have a larger growth, or your intrinsic value is growing, and they don't pay a very good dividend. So if you want a dividend stock, a dividend ETF, you might go into something like the S&P 500. The S&P 500 is going to pay a little bit higher dividend because it has more dividend stocks in there, like IBM pays a higher dividend than Microsoft, for example. So you have the intrinsic value and the extrinsic value. And so those are important things to take into consideration on when you're buying and selling stocks. Are you going to hold it for a long time? And are you going to try and pick up that intrinsic value? Or the extrinsic value along with the intrinsic value? Is that important to you? Or are you just a growth stock and you want to see that thing go to the moon? You don't really care if it pays out, 1 or 2% extrinsic value in a dividend. So you take all that stuff into consideration. So when we're building our own private hedge fund, those are things that we'll talk about, and those are things that we'll do. All right. So this bond is giving you 2.68%. Let's go back over to the next one. The next one is iShares BB rated corporate bond. And you can see this one's intrinsic value has gone up quite significantly from its low, from 42 all the way up to 46. All right, $342 per share. All right, or per 100 shares. So that's your intrinsic value. So it doesn't mean that when you trade your bonds, you're not worried about the intrinsic value. You certainly are, but more interesting is on these bonds is the extrinsic value. And in this case, this one here is returning a 6.25% on average extrinsic value. All right. Extrinsic value. That's your it's not really, well, I won't get into that right now. Hold on a second. Let's go to the next one. I was going to say it's not your dividend. Okay. I don't want to leave you hanging with that thought that I had. That 6.2% is not really your dividend. It's the bond return, but they call it dividend. So, it's just how much money you're going to get. And we call them dividends. It's not really a dividend when you're doing bonds. All right. Because the bonds don't make money. So what a dividend is that's like if Microsoft does well and they make a profit, they share it with you in a dividend. Well, in bonds, they're not making money that way, right? I mean, it's not a profit, so it's not really a dividend. We're cutting hairs. So anyway, when you're trading bonds, they're not really a dividend, even though they'll call it that. It's a distribution. It's a distribution of the bond. So your percentage of the distribution is 6.25% on this bond. And that's all I was going to say. Just wanted to split some hairs there with you. All right. So now we're going to come into the Van Eck. Van Eck. You've heard Van Eck. Van Eck Trust Van Eck High Yield. Okay. So HYD. This is the Van Eck bond. And we're going to come in here to the notes. You can see that one's at a 3.8%. Now, Land, should I diversify across my bond portfolio, or should I just put them all in this one BKLN, which has a high 8.72%? Well, remember, it's an ETF. And so it's already diversified, but it's diversified into some pretty aggressive bonds. So it's already diversified. So you're diversifying your diversification by picking several different bond funds. Is that a good thing? It's up to you whether you want to diversify your diversification. You could pick two or three of these. I'm not going to say you shouldn't. You certainly can. It's just like saying, well, should I buy the S&P and the QQQ and the Dow? Well, you can. They've all got kind of different returns on them. The S&P returns on average 10% a year. The Qs have been returning on average 30% a year. But the Qs bounce all over the place. The intrinsic value goes crazy, right? Lots of ups and lots of downs. Whereas the S&P, because it has 500 stocks, a little more stable. That's why it only returns 10% as opposed to 30%. The 30% is full, all these big growth funds, and they bounce all over the place, and you have lots of intrinsic value increase and decrease, and very little dividend given to you on those. So it's just a different world of, what's most important to you. And do you want to have a little bit of this and a little bit of that? Sure, do both of them. There's nothing wrong with that. All right, so now we've got the HYG, and we're going to go into the note. And this one here is returning about a 5.73% on average return. Okay, so take a picture of that one if you like that one. That's 5.73. That's pretty darn good. Okay, so now we're going to come over here. We'll go to JNK. This is junk bonds. You've all heard of junk bonds, all right? So junk bonds are high yield bonds. This is through the Bloomberg organization, and they got a junk bond, a junk bond ETF bond that you can join into. So let's go into the notes, and you can see on average that thing's returning 6.36%. So if you want to get into some junk bonds, okay, so put some money in that one. It's $95 a share right now. And that mostly it's been stable, but the markets have been a little crazy lately. So we've got one big long move lately, but you can see for the most part, it's just kind of it's a pretty stable market. It doesn't move a whole lot. And that's kind of, when you're trading bonds, that's kind of what you want. You kind of want that stability. That's why my son's telling me, hey, Dad, you need to slow down on some of this intrinsic value and kind of go to the little bit slower markets. I'm like, all right, Ben, I guess we can do that. We'll put some money over here. So we come into our investment grade shares, iShares box investment. So here's another one. Again, they all kind of look very similar with this big run, don't they? I've all had kind of this nice big rally lately. And now they're starting to stabilize a little bit. It looks like out here, we'll kind of get back into the little stable area, I'm going to call it. All right, so let's come in here to the notes. Take your camera. This one's going to make about a 4.04% return on average. And of course, these change a little bit, so these are not set in stone. That's why we have a date on them. You can see 1/25/24 is when that was. That was yesterday when I was doing all this research for you. So I actually did plan this lesson for you guys, believe it or not. So I spent some time putting this together for you. And in here, we got the preferred ETF, global ETF. And again, it's got that big intrinsic value run that's went from 17 to 19. That's $2. It looks big, but it's only $2. It's actually more like this. You spread these charts out on the screen and from high to low, and that's what it ends up looking like, a big move, when in reality it's not that big of a move. It's just kind of, mostly this thing's pretty darn stable. So that whole move from top to bottom is only $2. But $2, when you're going from $16 to $19 and you got 100 shares, so that would be what, $116,000 investment would be a $254 move. What's the percentage on that? Preferences percent. That's a 14% move on your intrinsic value. So, it's something that you should be mindful of. I'm not saying you shouldn't, but that's the value of your house increasing over time and decreasing, but you're really there to collect the rent. So let's go back over to the next one. The next one we got is the Spider Portfolio High Yield Bond ETF. And again, this one's kind of rallying up. We got a nice little intrinsic bump on it. But what is our extrinsic value? 7.27%. How about that? That's a high yield spider bond. That's a pretty cool one. All right. 7.27% on that one. Plus, it's increased nicely on its intrinsic value. So let's come in here and go to the last one. We got USHE, which is USHE. And this is one that Ben was recommending he likes in class. Oh, and for you guys who are in that class, PFFD is the other one he had in his list on the board, and he typed PFFT when he put it down there. And he's like, Dad, will you tell those guys I didn't mean PFFT. Just off the top of my head, it's PFFD. D is in dog, not T is in tango. All right. So these are his two recommendations. He likes PFFD and he likes USHE. So USHE is the other one, and if we come in here, you can see it's had a nice intrinsic value run. But if we come into the notes, you can see it's a 6.6% return on that one. So 6.6% return on USHE, and that is your corporate bonds. And so that's pretty safe, but it's corporate bonds, so it's given a pretty high yield. Of course, a lot of times when a corporation puts out their bonds, it's because they need to borrow money, and they might default on their money. But again, you don't have to worry about that. You don't have to worry about that. These bond managers are going to handle that. That bond has a whole bunch of stocks in it, or a whole bunch of bonds in it. And if one of them goes bad, it doesn't affect it a whole lot. They take that one out and put another one back in. So they're the ones handling that. All you have to do is just give them your trade your money on the outside, right? Trade the stocks or the shares on the outside, while they manage the bond fund itself. They're going to manage that ETF for you while you just, collect the 6.6%. All right, guys, that is a quick rundown of the bond funds that we talked about in class the other night, and thought I would bring those up for you and give you the interest rates on those bonds. And remember, if you're 60 years old, the recommendation is you should have 60% of your overall investment in these bonds, while 40% is over in the more aggressive individual stocks, where we're going to talk about that in our next class. We're going to start learning how to do that side of it. So we're going to go in and start learning how to build our little hedge fund portfolio with stocks. And for those of us who are 60 years old and over, we're going to have about 40% of our money in that and 60% in this. And those of you guys who are younger, let's say you're 30, it's going to be the other way around, right? You're going to have 70% in the stocks and get aggressive and trying to have some aggressive growth. And you're only going to have 30% in the bonds if you're going to put any in bonds at all. So it depends on what you want to do. And then you're going to calculate how much money do you want to have per year as an income replacement, right? And once you build yourself up to that level and you can put it in a bond and the bond return enough money that you can live off the interest, c'est la vie. You're done. You can just live off your interest and let it grow. And of course, it depends. I don't want to ever quit. I mean, I'll never retire. I'm only 60, so I say that now. What's I'm going to feel like in 5 years? But I'm never going to retire. I don't care how much. I'm just going to keep putting more money in there. Getting more and more. When have you won the game? When did you win? You passed go. You collect your money. Now go fishing. I don't know. That's not for me to decide for you. All right, guys. I hope you enjoyed that class, and we will catch you. Oh, we got to go see what our trade did. Oh, it's just bouncing around. It's doing nothing. We're down $10. It didn't go down to our blue line like we thought it was going to. It's getting ready to rally right now. Do you really want to hold on to it until it goes up and stops us out? Because it might just turn around and go back up right now. And we're down $10. You want to just get out with your $10? Yeah. All right, guys. That's our class. I guess I got to go over there and put $16.50 loss in today's trade Excel spreadsheet too. So I'll do that. And we'll catch you guys tomorrow. Take care.